Nand was sitting with Nilkanth in the evening. Nand was looking at some papers and seemed confused. Nand said, Nilkanth, I keep hearing the words capital gain and capital gains tax. What exactly do they mean? Nilkanth smiled. Nilkanth said, Let me explain it with a very simple example. Imagine you buy something for 1 lakh rupees. After some time, you sell it for 1.5 lakh rupees. Nand said, Then I made 50,000 rupees? Nilkanth said, Correct. In simple words, that increase in value that becomes a gain when you sell the asset is what we are talking about when we discuss a capital gain. Nand nodded. Nand said, So capital gain means profit from selling something I own? Nilkanth said, Broadly, yes. But the tax calculation can have specific rules depending on what you sold. What kind of things? Many things. For example, a house, a piece of land, shares, mutual funds, gold, and certain other investments or assets. Nand looked interested. So, capital gain is not only about shares? Nilkanth said, Exactly. Let's look at a few examples. Nilkanth opened his notebook. Suppose you buy a piece of land for 20 lakh rupees. After several years, you sell that land for 35 lakh rupees.
Nand, so my profit is 15 lakh rupees.
At a basic level, yes. But for tax purposes, you cannot always simply take selling price minus purchase price and stop there.
Why?
Because the tax calculation may take into account the applicable cost rules, eligible expenses, and other provisions. So the tax department looks at the actual calculation, not just the simple difference? Exactly. And the same thing can happen when I sell a house? Yes. A house or land can result in a capital gain when sold. What if I sell my house for less than what I paid? Then you may have a capital loss, subject to the applicable tax rules. So property can create either a gain or a loss. Correct. Nand became more interested. Nand, what about shares? Nilkanth, suppose you buy shares for 1 lakh rupees. Okay. Later, you sell them for 1.4 lakh rupees. Then I have made 40,000 rupees? Correct. That is the basic idea of a capital gain. What if the shares are currently worth 1.4 lakh rupees, but I haven't sold them? Nilkanth smiled. That's an important difference. Why? The investment has increased in value, but you haven't actually sold it. So you generally have an unrealized gain at that point. And when I sell it, then the gain becomes realized, and you need to consider the applicable capital gains tax rules. Nand looked at his investment statement. Nand, I also have mutual funds. Does the same idea apply there?
Yes. Suppose you invest 2 lakh rupees in a mutual fund.
And later I redeem it for 2.70 lakh?
Then, broadly speaking, there is a 70,000 rupee gain before considering the detailed tax computation.
So mutual funds can also generate capital gains?
Yes.
And I need to know how long I held the investment?
Absolutely. The holding period and the type of asset can affect whether the gain is treated as short-term or long-term, and what tax rules apply.
Nand looked serious. So I shouldn't just look at the profit amount.
Correct. You also need to look at the nature of the asset and the applicable tax rules.
Nand suddenly remembered something. What about gold? Suppose I buy gold for 1 lakh rupees and later sell it for 1,50,000? Then you have a gain of 50,000 rupees before considering the detailed tax computation. So gold can also create a capital gain. Yes, depending on the type of gold and the transaction. What if I sell jewelry? The tax treatment can depend on the nature of the asset and the applicable rules. So don't assume that every asset is taxed in exactly the same way. Nand nodded.
Nand suddenly became excited. Nilkanth, I understand everything now. Really? Yes. Whenever I sell anything for more than what I paid, the entire difference is always taxed as capital gain. Nilkanth smiled. Not so fast. What did I get wrong? First, you need to determine whether the asset is actually treated as a capital asset under the tax rules. Then you need to calculate the gain according to the rules applicable to that asset. So I shouldn't blindly use selling price minus buying price? And then I have to consider the holding period? And then the applicable tax rate? And there may be exemptions or other special provisions? Exactly.
Nilkanth wrote 4 questions in Nand's notebook. Whenever you sell an asset, ask 1. What did I sell? Property, shares, mutual fund, gold, something else? 2. What did I pay for it? Find the relevant cost according to the applicable rules. 3. What did I receive when I sold it? Find the relevant sale consideration. 4. How long did I hold it? This can be important in determining the applicable tax treatment. Nand looked at the 4 questions. Nand, so these 4 questions give me the starting point for understanding capital gains? Exactly.
What happens if I sell something for less than I paid? Then you may have a capital loss. For example, I bought shares for 1 lakh rupees and sold them for 80,000 rupees. That would be a $20,000 loss before considering the detailed tax computation. Is that loss completely useless? Not necessarily. Depending on the type of capital loss and the applicable tax rules, it may be possible to set it off against eligible capital gains or carry it forward. So, even losses have tax rules? Yes, that's why you should understand the nature of the gain or loss before filing your tax return.
Nand closed his investment statement. Nilkanth, now you understand the basic idea? Nand looked at Nilkanth. Nilkanth, I have one last question. What is it? Nand, if short-term and long-term gains are taxed differently, can you explain that next? Nilkanth smiled. Of course, that will be our next lesson. This is only the basic introduction to capital gains. I always recommend that anyone who truly wants to understand capital gains should learn it through practical examples. Whether it's shares, mutual funds, gold, property, or any other asset, calculating the capital gain yourself using real transactions makes the concept much easier to understand. Practical learning not only clears doubts but also builds the confidence to calculate capital gains correctly in real-life situations. Nand closed his notebook happily. Now capital gains don't sound so scary. Nilkanth, that's the idea. Tax becomes easier when you understand the story behind the numbers. Thank you for watching the video where Nilkanth explains to Nand the basics of capital gains. Money books. Join us in the next lesson as Nilkanth continues to make tax and investment concepts simple and easy to understand. See you in the next video.